Hello and welcome back to Night Onomics. We're here sort of for chapter 2 of our journey through investing, and today we're going to learn about the three main asset classes. So we're going to learn about fixed income securities, equity securities, and derivatives, and we're going to dive into those pretty heavily. And so after today, you should definitely have a very good understanding of how each of these different types of securities can be used in your own portfolio. And that's the goal for today. So let's get started here. So the first thing we're going to talk about is the money market. So the money market. Let's write that down here. So let's talk about what that is. So let's just write money market securities. And so money market securities are essentially any security that matures in less than a year. Sometimes you hear people say less than 270 days, but for all intents and purposes, it's simply short-term securities. So short-term securities that mature in less than a year. That mature in less than 1 year. And so a lot of times this is what banks use to meet their obligations, what corporations use to meet their obligations, and so it's a very large market being used by a number of people out there. And so let's start. So I guess we'll list off some examples and make sure I get some here. So I guess the first one we have here are going to be T-bills. So these are treasury bills. They're a U.S. government issued. So they're U.S. government issued. They're very short term. They have maturities of you have 13 weeks, 26 weeks, 52 weeks, and so I guess let's put that here. So maturities of 13 to 52 weeks, and so that's why I say it's 1 year. Some people say 270 days, but T-bills go up to 52 weeks, and so that's why I say 1 year. And so that's T-bills. And so how these, so I guess let me sort of define maturities here. So what does maturity mean? So a lot of people ask, oh, what does maturity mean? And this is essentially the length, or the length of the loan. So length of loan. And so this I guess this is a good time now to maybe backtrack a little bit, talk, okay, what is money market securities fall under what's called fixed income securities. And what these are is they're essentially bonds. So you'll hear people say bonds. So here's some different names. Bonds. Or you'll hear some people just say debt securities. All these fixed income bonds, debt securities, they're all the same thing. And so how these work is they're essentially loans. So you're giving someone money today to get money in return tomorrow. In this case, in money market securities, it'll be less than a year. So let's give an example. So if we're doing a T-bill for 52 weeks, and let's say for example's sake, you will loan / give the U.S. government let's just say $10,000 today at, well, let's just say let's say 2%. And so what that means is 52 weeks from now, so in 52 weeks, the US government will pay you back the 10,000 plus interest at 2%. So this is the right interest here. And so that's going to be, $200. So they'll pay you back $10,200 at the end of the year. So you make 2% over the course of the year. And so this applies to, and so again, this example is money market securities. I'll do this same example for longer term bonds, and it's slightly different because you have interest payments every 6 months, and but for T-bills it would look something like that. And if it was a shorter term, so for instance, if it was 26 weeks, you might still have the 2% interest annually, and then it would just be essentially, if it's 26 weeks, it would only be essentially 1%. And so that's how T-bills work. I think that's probably everything you need to know about T-bills. And so the next one I have on here for the money market is going to be, let me clear this, is going to be certificates of deposit. So certificates of deposit, also known as CDs. And so these are things that you can go to your bank and get yourself. Sometimes they're longer terms, and so I guess the definition of these is going to be just a bank time deposit. And so remember, with all money market securities, these will be less than 1 year, and so these are going to be time deposits less than 1 year. Less than 1 year. And I guess that's really, and then they would work the exact same way as the T-bills. If you do a $10,000 deposit at 2%, you'll get your $10,200 back at the end of the year. Typically with CDs, there's also penalties if you want your money back early. In terms of T-bills, you can sell it on the open market and it should be fine. But that's just a little hiccup depending on the bank you're going to. And so, yeah, and so that's CDs. Now we can move on to something called commercial paper. Commercial paper. And so I guess we'll call this CP. And so these are typically going to be 270 days. These are essentially used by corporations, and so the easiest example is, if a corporation sells another corporation goods or supplies, they may not get paid for a month, 2 months. And so what they'll do is they'll use this commercial paper to get paid, and then they will pay that back when they get paid. And it makes trade a lot easier, a lot more fluid. Let's see if I have anything else on my notes. Yeah, I guess that's probably it for. I think that's all I have on my notes, at least the important stuff. So I guess I can put what I have is the technical definitions. So short term. unsecured debt. And so what this means is that it's essentially just, you don't have anything backing it. So secured debt would mean, you have some assets backing that debt. Unsecured is essentially just a word of mouth promise. I promise to pay you back. And so it's essentially just a promise. And so you can imagine if a company's credit rating isn't so good, then they might have a harder time getting a commercial paper loan. But I guess that will just depend on company to company. And so I guess the next one I have here is bankers' acceptances. Let's see if I want to do a new page. I'll draw a line down the middle. So we have bankers' acceptances. Alright, and so from here, we're going to customer to pay us some money. Okay, so these are, I guess I'll put the textbook definition here. So this is an order by a bank, okay, I guess I meant to say in order to a bank by a customer to pay us some money at a future date. And so these kind of go hand in hand with commercial paper. So essentially how these would work is, let's say you have corporation A over here, so you have A and you have B, and they're making trades, and so A might give B some goods, so these are goods, and then B is supposed to pay A for the goods, and so B will very likely go to a bank and say, so B will go to a bank, let's draw a bank down here, so here's the bank, so B will go to the bank and say, hey, pay A when I receive the goods, when I receive the goods. And so then when they receive the goods, and then the bank will pay B the money. And so let's just say they put money here, they send the money here, and so that's typically how it would work is, A and B will likely be in a contract for trade, and B is gonna just put money in this bank and say, hey, when A gives me my goods, I'll let you know, you release the money to A, and we'll be all square. So as I was saying, so that's how these banker acceptances work. Let's see, is there anything else I have noted here? I guess that's probably it. So the next one, let's go on, is Eurodollars. So Eurodollars, and so these are dollar-denominated deposits at foreign banks or foreign branches of American banks. And so these are dollar denominated. So let's write these down here. Dollar denominated deposits at foreign banks. And so you can think of these as foreign, I guess, and by foreign banks, I mean, foreign, let me put in here, foreign U.S. banks. So U.S. banks that are based in a foreign country. I guess I should I can probably clear that up. Okay, that's probably fine. So I have foreign U.S. banks. I think that's straightforward. And so I think that's pretty straightforward. If you're a firm and you're doing business in another country, you might be more familiar with a U.S. bank. You probably have an account with a U.S. bank. So you'll do dollar deposits in those banks in the countries you do business in. And so the next one is repos. So I guess the repurchase agreements, more commonly called repos, repurchase agreements. So repos. So these are these are short-term sales of securities with an agreement to repurchase securities at a higher price. And so, form of short-term. How do I want to say this? Borrowing the dealer sells securities to an investor on an overnight basis. Okay, yeah. So okay. So these are essentially overnight. So these are essentially overnight loans. That's probably the easiest way to think about these, just overnight loans. And so how these work is you have, let's just say you have A and then you have B, and so A will borrow, okay, yeah, so A will borrow from B, and so this is borrowed funds, and then the next day A will pay back, so pay back at a slightly higher rate, pay back at a slightly higher rate. At a slightly higher, I guess you can say, amount. And this will be determined by the repo rate, and so determined by repo rate. And so you've seen that recently in the news, the Federal Reserve has been getting involved in the repo market to help facilitate more trade, because this is very important for the economy, for banks in particular, to be able to borrow money overnight and then they'll pay it back. And this is essentially what happened in the financial crisis that caused a huge liquidity shock, as banks stopped loaning money to each other, and so that repo rate essentially spiked up so high that that trade ceased to exist. And that can be an issue, because then banks run out of money, because generally banks take on more deposits than they have in the bank. And so then if everyone comes to get their money out and the bank doesn't have it, that can cause chaos. And that's what happened in the Depression. Well, I guess there was a depression, yeah, in the last two depressions we had, obviously in 1929, and also one in 1893 was actually a bigger depression than the Great Depression. You had a run on the banks. These repos weren't happening, and it just caused chaos. And so like I said, the best thing with these is just overnight loans. And I think that's probably exactly what I will do. I mean, I guess so they do have, and so these do, I guess, so I put overnight, but agreements can be up to 30 days, and so agreements can be 30 days, so they aren't only overnight, they are short-term in nature, but in many instances they are overnight. And so that takes us now to broker's calls. That's the next money market instrument, is broker's calls. What do I have noted here? So these are, so I guess this comes into essentially margin calls. So margin calls. Borrowed from the bank, and so margin call money is borrowed from banks, and so that gives us a new term here. So a margin, so trading on margin, is essentially what you can do if you're trading stocks on any sort of online broker like TD Ameritrade or any of the others, you can borrow money from the broker to buy stocks or securities. I always do that, to buy stocks or securities. And this is important. This essentially gives you higher leverage. So let's say so we can give you an example here. If you have $10,000, you might be able to borrow 5,000, and then you can borrow 5,000 plus. Okay, we can borrow 5,000. Now you have 15,000 that you can buy stocks with. Now you can buy $15,000 worth of stocks, so you can get a larger gain. Your percentage will be the same, but your overall gain will be greater. And so how that works is, if you buy $100 stock, so $100 stock, if you just have 10,000, if you just have the $10,000 amount, then you can essentially buy 100 shares. You can buy 100 shares, and then with $15,000 you can buy 150 shares. And so if your gain is a $10 gain, overall this is still just a 10% gain, but your dollar value gain will be higher. So here you gain $1,000, while here you'd gain $1,500. And so now there is going to be a cost. So essentially what these margin calls are is the broker who loans you money is borrowing that money from a bank, and so that bank's going to charge them a percentage. So then the broker will charge you a percentage on top of that. So they'll make a slight profit on your trade, and that's how these work. But still, you can see, assuming the interest rate isn't, unfair. And by unfair, I mean like 30-40% interest. This is very helpful. Trading on margin is very helpful. And so that's what brokers' calls are. So let's go to a new page here. And so the next one is federal funds. We all hear about this in the news. So the federal funds rate. So the federal funds rate, also known as the FFR. So this is the rate that the central bank controls, or the Central Bank of America is the Federal Reserve Board. And so what these are is, this is the rate, the interest rate for funds in the Federal Reserve at the Federal Reserve Bank. So it's a very small rate, and so again, this is what the Federal Reserve controls when they lower rates or increase rates. Commercial banks at the Federal Reserve Bank. And so let's see, is there anything else I want to say here besides the economics part of it? Yeah, and so is there anything else here? Funds in the bank's reserve account. Yeah. Okay. So that's just what they are. So if banks have more money in their reserves than they need, then they will just send it to the Federal Reserve, and they'll get interest rate, and they'll get a small interest on that. And this is the rate that the Fed controls. So the Fed can lower. So the Fed can raise or lower. Or lower this rate, typically to control inflation and unemployment. And so that's the dual mandate that you occasionally will hear of, and unemployment. And so when Congress created the Federal Reserve Board, or the Federal Reserve System and the central bank itself, they gave them a dual mandate. So these are going to be the dual mandate. A lot of times, you'll hear people talk about the dual mandate. Sometimes the Federal Reserve Board will forget that that's their dual mandate, and they'll think that they are also supposed to influence output or GDP, and they're not supposed to. Now, obviously, they are tied hand in hand. Inflation, unemployment, output, they are tied closely together. But the dual mandate for the Federal Reserve is to maintain stable inflation and maximum employment. And so that's what the federal funds rate is. And then we can go to LIBOR, which is essentially, you can think of this as the rest of the world's federal funds rate. But so LIBOR is the London, I think it should be interbank. Yep, interbank offer rate. And this is essentially the rate, again, of what banks will loan each other. London's bridge rate, which is large banks, yeah. So it's essentially the same thing. It's essentially London's version of the federal funds rate, and so it's the rate banks in London will loan money to each other. And so this is important. So when you go back to the financial crisis, LIBOR essentially spiked up really high because the banks in London stopped loaning to each other, and that caused a huge liquidity crisis in London that sort of spilled throughout the world. And so that's really, I guess, not too much more to say about that. It's just it's what that is. And then I believe that's all I have for the money market. There might be a few more securities, but let's call this end of money market. And the money market. Okay, and so that'll do it for the money market securities. It was sort of a dry lesson, but I think they're important terms to know. As you get more familiar with the investment terms, I think that it'll make a whole lot more sense. And when you see these terms, say, "Hey, I know what that is. I know what that is," because you do hear people about this, about the money market securities, talk about them pretty often. When you're watching news and things like that. Especially the federal funds rate, it's good to know what that is. It's not just some tool, some vague interest rate that is being used to control the economy. And so, for now, that's the end of the money market discussion. Night Economics is signing out, and I will see you next time.